Hello traders, welcome to FreeFX, your educational resource. Today I'm going to do a second part to a video that I made yesterday, which is really about creating a system when you first start trading or intend to trade. And in the first part, in the first video, I talked about the idea of trading, sort of how to build that activity around your needs and what your lifestyle might be. And then I started just briefly talking about different time frames on a particular pair. It was Euro US dollar, and then in fact no, it was pound yen. Sorry. And then I was looking at the way in which the 5-minute chart kind of fits into larger time frames up to the daily and so on. So today I'm going to delve a little bit further into that, and as part of that I really want to talk about the idea of the targets including stop losses. Now there are different scenarios here, so let me start with this chart in front of us, which is the FTSE 100. That's the Financial Times and London Stock Exchange index. This is also known as the UK 100. I'm choosing this because I know it's an equities index, but I really just wanted to use this as a chart because I've been looking at this quite a lot recently. So now today's made some good moves. It's got a little bit of a downward trend, which has started a few months ago actually. So this is really quite a useful chart to see in this way. It fits different time frames because they kind of all combine in the same kind of direction. So let me start with a 5-minute. I know a lot of people trade shorter time frames when they start, but I don't want to make assumptions. But let's say so that nobody trades this, but me at the moment. I don't trade a 5-minute, but let's say that we were starting on this and we're looking at this trade and we're trying to decide where to go. But let's go back a little bit because we're going to pretend that we don't know where the price is going. Okay, so let's say that we didn't know where price is going and we were just around here. So let's say the latest candle was here and we wanted to know where to trade in the future. So we look back and let's say that a time frame reference, if you're on a 5-minute chart, okay, so we're just sort of, it's not a day of a day's worth of trade data. It's probably something like an hour maybe, or a couple of hours. Try to find some kind of equation that you say, well, if I trade a 5-minute, my sort of immediate reference point would be no further back then. So if all you want to know is sort of where to move within the day, so let's say that the time was 2:35 here, and you were going back a couple of hours, okay, maybe further back. Okay, so 2:35 going back to 11:15. That would give you 11 to 1. Okay, about 3 hours and 20 minutes, 3.5 hours. Maybe you want more. Okay, so just decide basically how far back you want to look at data, because obviously with a 5-minute there's a lot of movement, and it can be quite confusing if you look at a lot of data, because you see it's kind of starting to, if this, for example, let's go back to the start here. Let's say that we only had about 2.5 hours worth of data, and you said, okay, we're at this point, where would I put an entry next? Well, I see that there's a descent here, and I was kind of bounced back from here. So you start by putting a level, and for that we choose freehand, just a little line here. So let's say this was a support level with buyers coming in here and buying off, and then again, as you can see, there's a strong move from there. So then you might say, okay, well, and the highest level at this point from the data that I have in front of me seems to be this here, okay, more or less. Okay, then you need to decide another thing, which is, do you want to look at the wicks or do you want to see the bodies of the candles? I explain. This line is sitting just under the bodies, okay? So for the red candle, the close would be lower than the open, okay? So where the line is. For this blue candle, the close would be above, okay, at the top end of its body, okay? But we then want to put everything in the lower part of the body of each candle. Lower part here as well and there. Okay, so we ignore the wicks. Here then, similarly, we'd have to ignore the wicks and go for the top of the bodies there. Okay, so this would be at the 6.31. Now, the further out you go into sort of daily, weekly, monthly time frames, the more approximate your targets may be. You might prefer round numbers because you look at bigger moves and levels get obviously torn through by quite a margin, maybe a couple of hundred pips. The levels then may, the price may retreat behind those levels. With this sort of time frame, you can be very, very precise, and so 6.310, 6,310, this is 6,313, okay? So let's say that this was your range. Now you need to sort of find an entry. So your price was kind of going up here, and you were trying to decide where to come in. And then you need to start deciding on your risk-reward ratio, which is where we go next. So let's kind of take this ruler here and measure the range from here, this point to this point. And it tells you we are at 26 pips. Okay, 26 pips. So we've got 26 pips to play with. Let's do some maths then. 26 pips would be, let's bring it in there. Okay, so 26 pips, good old calculator. 26 pips, okay? So let's say that you wanted to double what you risk. So 1 to 2. Okay? So we divide this up into 3, okay? And then multiply it by 2. Okay? So you want basically 17 pips gain. Okay? So your entry would be 17 points below the profit area. So 26 is the entire range, and 17. So it is 6313. 17 would be 3131. Let's have a look again. Yeah. So 17 pips would be around here. 6.296. Okay. 6.296, about there. Okay. So this would be your target. Sorry, no, what am I talking about? This will be your entry point, and this will be your target. So let's label things as we go. Are we clear about this? I hope so. Please send me some feedback if you're not particularly clear about this, because I'm going to type things in here. So profit target. Okay, that's there. And this is your entry point, and this is your stop. Okay, so let's make that like that. Okay. So we have the stop loss here, the entry here, and the profit target here. Okay, so you can see there's 1 risk versus 2 reward. Okay, now, so let's say we entered here with the expectation of price going up, because we've seen this sort of pickup, and we think that this is going to go back up. So let's find out, scrolling forward, what happens to the price. Like, it's gone up a little bit more, and well, there you go. You would have actually got in your profit, because there you go. If you extended your line, you see the price went up. Now, I've actually done this completely casually. Believe me, I didn't know. I just went back on price and then forward again. So I've done some sort of forward testing in the past, and this is a very good way to kind of to try your trading ideas. Obviously, there's nothing like present conditions, as things change and ranges change. But certainly, one thing that you can do, if you want to sort of try to gauge overall as an average for X amount of periods, whether it's days or 5-minute candles, you can use something that I like to use a lot to see, to gauge sort of the range of a. This is the average true range. I'm using FXCM MarketScope 2.0 trading station. So this is the range. It's 14 periods. So if you're on a 5 minutes, that's obviously 14 times 5 is 70 minutes. So it's an hour and 10 minutes essentially. So you can extend that if you wanted to. If you wanted it to be 5 times, what would it be, 50 minutes, that would be 10. So you could change that to 10. Okay, let's keep it 14 is the standard, because when it comes to the daily chart, 14 would be 2 trading weeks. So 14 trading days, which is obviously over 2 calendar weeks. But that's basically why it's 14, I believe. So that's where we are. So we're going to do that. Now you see the trading range here. It tells you right here. So on the 5 minute, that would be 8 pips, 0.14. Okay, so we've gone for a 17 pips. So that's basically our target is double the average true range of price at the moment. This is obviously going into the present, which is further up here. Okay, we were just further down here. So our entry was at this point. Okay, so we entered here on this candle. At this point, the average true range was 6.83. Okay, so had we used the ATR, we would have gone perhaps say double of 6.83. Let's make it 7, would be about 14. So would it be about 3 pips and a bit over the double the ATR for the 5 minute at this point. Okay. Now obviously these things come in ranges, and what I mean by that is that let's say that the average true range times 2 was 16 pips here. But as you know, as you can see here, this swing obviously went over. Okay, so you can obviously go slightly over with the expectation that the average true range, is sometimes slightly below what might be. Conversely, you might say, I want to be a bit more conservative. Instead of having a 2-to-1, I can have a slightly less, let's say there. Okay. So let's say that your top of the range here, you thought, well, that's basically unlikely to be hit exactly square on the mark. So I'm going to go slightly lower and sacrifice a few pips, but to make sure that when I walk away, this order might get filled, but I don't have to sit there and sort of click the button in case it misses it by half a pip. So in this case, then, you would have had a risk-reward ratio of exactly 16 pips versus your 8. So exactly, basically a 2-to-1 exactly. So that might be a better example of that. So let's say that this was your risk reward 2-to-1 with a 16 against 8. Okay, so that's basically another example of what you might do. Sorry, the telephone in the other room is ringing, so that's making a bit of a noise. Now, the other thing we're going to talk about, just very briefly, is once we've got this set up, you got your average true range. The other thing you can do is you triple that, so you go for 3-to-1. Okay, so instead of 16, you might go to slightly further out. Now, obviously, you need to check sort of what other levels there might be. As you can see here, where we were before seems to be more reasonable, because as you go further back, this seems to be a level that's been sort of touched or seems to have something connected to it in past history. It is worth remembering that your stop loss can come in different forms. It can be the trading stop loss, can be the fixed stop loss. So for smaller time frames like this, it might be better to actually have a fixed stop loss than a trading. Now, obviously, as you can see, your order got filled. If you put it slightly further up, say above the wicks here, okay, it might have just been missed, and then you would have basically been stopped out. So what happens is, let's say that you got greedy and you've gone for a 3-to-1. So instead of double, you've gone for 3-to-1. Okay, so 8 times 3 is 24. I think that's probably what's 36 a bit further out. So had you gone to about 24, let's say about there, obviously you would have missed your target and you would have basically been stopped out. Okay, so sometimes being conservative with your targets can actually help you out. Yes, you gain less pips, but you have more probabilities of actually getting your money's worth of that trade from that trade. So just remember that the smaller time frame is something that I haven't really covered before. So this is basically how they operate. You have to, the quick movements up and down. So you might be better off having a small. If you also reduce your stop loss, that also increases the chance of you sort of losing less, obviously. But then sometimes if you basically put this back here, for example, okay, sometimes if it's too close and you enter here, let's say you entered here, and this went against you, if you had it here, this would actually fill your position, and risk reward would be slightly over 1 to 1, maybe 1.5 to 1. So just remember that you have to be reasonable with your stop loss as well. Give it enough room. Okay, that's all for today. We'll continue this topic probably further on. And thank you very much for listening.